Markets have been paying increasing attention to geopolitics and its impact on financial markets. Most investors still view market movements as a function of macro fundamentals, growth, inflation, and central bank policy. The problem is that interpretation only holds if the global order remains stable and if geopolitical shocks remain contained rather than systemic. This conversation is for investors and capital allocators focused on risk, not just return. And today, we take a closer look at how shifting geopolitical dynamics, energy shocks, and market positioning are beginning to reshape the investment landscape. I'm Sahhar Saleh, and this is Insights Over Coffee. Joining me today are Guner Turkman, CEO of Lake Geneva Investment Partner, and Ilias El-Bahraoui, Head of Asset Management at Lake Geneva Investment Partners. Together, we'll unpack how recent geopolitical events, from escalating tensions in the Middle East to broader shifts in the global order, are driving volatility across asset classes, influencing inflation expectations, and revealing potential stress points in credit and commodity markets. And before we begin, a brief disclaimer: this podcast is for informational purposes only and does not constitute investment advice.
So, Ilias, we've wrapped up the first quarter of 2026, and it's been quite a turbulent one in terms of geopolitics, market volatility from a great number of perspectives. Would you like to summarize for us what you saw in the first quarter and what you believe are the core drivers of the geopolitical situation we have so far at hand?
This past quarter, or the first quarter of 26, was extremely intense geopolitically. I have a hard time remembering when we had so many events around the world packed in such a short amount of time. Well, first, let's start with Venezuela. A few days into 2026, we had U.S. military storming the presidential palace and taking President Maduro out of the country. This totally caught the world by surprise. Also, it was pretty impressive militarily. The achievement of having done that with actually no casualties on the U.S. side. We had casualties on the Venezuelan side, though, was something that actually impressed the world, militarily at least. A few days after that, Greenland came back on the table, probably more seriously than ever. This frightened European leaders, and perhaps this is the first time Europe felt so naked, caught between an estranged Russia to the east and a hostile United States to the west. So all of this was very much felt during the World Economic Forum in Davos towards the last part of January. Greenland was a big topic. Everybody was talking about Greenland. And I would say even more importantly, what made Davos unique, in my opinion, this year around was the speech of Mark Carney. It was almost unthinkable before to have a Western leader deliver such a speech. Let me just read a quick extract from it. So I'm quoting Mark Carney here. "We knew the story of the international rules-based order was partially false, that international law applied with varying rigor depending on the identity of the accused or the victim. When the rules no longer protect you, you must protect yourself," unquote. So this was Mark Carney during the WEF of 26. And naturally, Canada has been also very much under attack and quite vulnerable, as President Trump made many times, or at least repeated the fact that it would be nice to see Canada as the 51st state. So just to give you how serious actually Canadians are taking this, and in a stunning leak, and this I read this on Bloomberg News, it was actually revealed that the Canadian military has modeled a response to a hypothetical U.S. invasion. So the model concludes that conventional defense is impossible. Instead, Canada would utilize insurgency-style tactics mirrored after those used in Afghanistan. The fact that such a simulation exists between the two world's longest-standing allies underscores the total collapse of historical certainties, and also how ironic is that, right? So yeah, I think for many, and especially European leaders, this is kind of the validation or the confirmation that there is a rupture of the old world order. And by the way, many saw the signs as early as 2014, 2016, especially as Brexit was happening. That was, I think, summer of 2016. Then you had the election of Donald Trump in late 2016. And basically, this is all kind of a rejection of the old world order, if you will, post-World War II world order, and the rejection of that political class that sort of dominated the West before this. So naturally, global financial crisis 2008 put a lot of economic hardship on many in these developed countries. The gap between the poor and the rich just grew from there between asset owners and non-asset owners. So it's all very much understandable now how we got here. But actually now we really feel that things are actually very much changing. That was the first 2 months of the year. Then, of course, we're now in the middle of a big war in the Middle East. So end of Feb, attacks were carried out on Iran, which was probably, we can say, is an episode 2. We had the 12-day war back last year, and it very much felt like that was not over. It just felt like an introduction to more is coming. And now we're in the middle of this 6-week war that seems to be quite difficult or complex to exit. The off-ramp is not obvious. One came lately, but we don't know if the ceasefire is going to hold. But basically, yeah, we have the Strait of Hormuz, through which 20% of global oil flows, is effectively a combat zone now. Also a significant number of energy facilities have been damaged in the GCC countries across the region, and consequences will definitely be felt at best for months, if not years. Basically, if you look at how the year started with Venezuela, it kind of gave, I guess, the U.S. administration a sort of a victory disease. And I read this somewhere. It was quite a good article saying that, yeah, this is called a victory disease. Things went so well militarily. Let me emphasize that, militarily, for the Americans, that it seemed like Iran is going to be easy. And what was supposed to be a 2-3 week project or military project, taking out the Iranian government and replacing it quickly with another one, turned out to be now kind of a bit of a nightmare, in the sense that we had what we discussed: the Strait of Hormuz is blocked, and the reaction of the Iranians was not something that was anticipated by many on the other side, including GCC countries.
Well, thanks for that, Ilias. Just while you were speaking, I was kind of thinking about, there's the geopolitical side on the one hand, and then there's the eventual market themes that have been kind of prevalent throughout the first quarter, and will probably continue to be prevalent going forward. Naturally, there's a whole story with oil supplies, the price of energy, the price of energy derivatives, and commodities in general. We kind of saw the initial knee-jerk reaction of prices and supplies. However, now we're going to see how that filters down into the market over time. There's naturally, on the equity side, there is one of the core drivers, the AI trade, which is still alive and well, even through this confrontation with Iran, which has been kind of the most prevalent news story and the most prevalent geopolitical equity market headwind that we've had. And together with the AI story, there's the whole AI build-out story that continues. In fixed income, we have naturally the inflation narrative that comes out, again, tied to the geopolitical stress and how that's going to affect European and US inflation going forward, on the one hand. And two, is it going to create a slowdown in the economy, or is the economy going to keep chugging along? These are facts that we will know eventually, not today. We will see the results of what's happened during Q2 more than in Q2 in Q1. On the credit side, Q1 was filled with news regarding private credit and high yield credit. It will take time for some of these themes and risks to develop. I don't think we'll have clarity over the private credit markets immediately. It may take months and even years to see whether there's going to be some fallout or not. And yeah, I think the market's been very much headline driven during the first quarter, because of everything that you spoke about earlier. But now I think we will see in the second quarter, particularly, whether these headlines have an effect, whether they had an effect on inflation, whether they had an effect on, and to which degree, of course, whether they had an effect on growth globally and employment on the global picture, whether they will have an effect on companies' earnings and companies' earnings expectations and growth expectations going forward. I think now we will see kind of the results of all of this. A news-driven market is very hard to manage for hedge funds, for investors, as the news keeps changing. But eventually it kind of trickles down into the macro and the micro. So we believe that Q2 will also be jam-packed, even if the geopolitical arena quietens down. I mean, just we're having this podcast just on the aftermath of a potential ceasefire that was agreed to yesterday evening. We hope that on the macro side things will calm down. However, we will still see the results of these in Q2, and we believe that we're going to have quite a bit of volatility going forward because of all of these. Are you seeing anything in particular on the fixed income and the credit side, apart from what we've discussed so far?
The rate market caught many by surprise. For a lot of people, fixed income, especially US Treasuries, European Treasuries, the G10 Treasuries generally act as a safe haven in generally events where you have a risk-off environment, where you have equities go down. However, not always. Of course, we've seen what happened in 2022, but this time around, we had, again, a correlation, a pretty strong correlation between equities and bonds for the very simple reason that with what happened in Iran, energy prices soared and actually reignited fears of inflation. And just, as a reminder, we were just coming out of a pretty damaging episode of inflation spiking, 2021, and basically that's very much fresh in people's memories. And the war against inflation is not won yet, as you can see, for example, in the United States with how cautious the Fed is. However, what happened before this, especially if you look at the last 2 years, you've had an anticipation, especially in the United States, that the Fed at some point is going to lower the rates. The White House wanted it. They've been pressuring Jerome Powell to lower rates, and the street wanted it because it's the easy trade. And also, the street thought that at some point inflation is not going to be an issue anymore and that rates will eventually go lower. And also this view that rates will go lower was also the view of the bear side. So the people who were, or the players who thought that economy could be in trouble and that the Fed and other central banks around the world will have to lower rates to boost the economy. So the result of this is that we had a continued inversion of the curve, at least in the United States and in a number of European countries, between the policy rate, so the Fed or the ECB funds, and the 2-year rate in these countries. So for example, in the United States, consistently, the 2-year US government yield traded under the federal funds rate. And that's not necessarily a normal situation. It basically translates, or what it tells you is there's an anticipation that the Fed was going to cut rates. So the market was little bit ahead of itself. And what happened in Iran set the clock back to zero. So we had a massive sell-off in the short end of the curve, particularly, even though the long end also sold off, but much more on the shorter end of the curve. So we had a bear flattening. And now, for the first time since 2023, the US curve is sort of back to normal. It is a relatively steep curve, which policy rate is the lowest rate, and then the 2-year and the 5-year and etc. So we've had that, and even though news around the ceasefire are kind of here, and things look much better for equity markets. However, the bond market having, for the time being, a hard time to recover. It's not bouncing yet. As far as credit markets are concerned, we can break it down into 2 parts. We can talk about public credit markets, and we can talk about private markets since they've been making the headlines recently. So on the public side, yes, we've had a risk-off environment to a certain extent. I mean, equity sold off, VIX rose, went up, and naturally credit spreads widened. Now, they widened to a certain extent, but we're nowhere near blowout levels. We are nowhere near the levels that we've seen a year ago during Liberation Day, when really the volatility spiked during the month of April as we had the tariff surprise from the U.S. administration. So yeah, we had a widening, but it was quite contained. And now, naturally, with equity markets bouncing, so are the credit markets. We have typically, if we take as an example, U.S. high yield, it went maybe from the index to plus 1% at the end of February to -1. So we've had a sell-off of 2.5% at best, and just kind of shows you that, generally speaking, credit markets have been resilient, even though they went into negative territory. Now, when it comes to private markets or private credit, it's a different story. What we track on our side, at least, are, as we discussed the other day, are the business development companies. It's a bit of the tip of the iceberg. This is the part that actually anybody can trade. These companies are listed on the US stock exchange, and you can trade them as a stock pretty much. And behind them, you got credit portfolios, or sometimes, private equity or private credit, mainly private credit. And this sector particularly has not fared well in the last 10 months. If we look at the index that basically regroups all the BDCs, there's actually an ETF for that called BIZD. That ETF is down. Actually, it reached its high in summer 2025, last summer. And from its peak, and if we take the lowest point that was reached during February, it's down around 22%. Since then, it rebounded. Now, I think it's down around -17 as we are talking now. So we've had quite a sell-off first of all, during this year. I think this year alone, it's down around 10%, even though it's bouncing. I think it was down at 12 at max this year. And basically, and this is pretty ironic, is when we started seeing a lot of headlines, especially during the month of March, many private credit funds or non-traded BDCs gating or limiting redemptions, sometimes receiving more redemptions than they can allow per quarter. The situation in at least in the publicly traded BDCs, the bleeding has stopped. So actually, if you look at the index, it was relatively flattish on March, maybe slightly a tiny bit down, but mainly flat. And now the question is, will we have a wave 2? Will the next move may perhaps be up and another move down will follow? Or again, some people would also wonder, are the troubles of private credit over? Maybe not. A -20% sell-off, is it enough? So yeah, all these, we'll have to find out how this sector will behave from here on. If 26 is going to get worse or better for private credit.
Well, all very interesting, Ilias. I think we have a very interesting market setup coming into Q2 of this year. We've had a lot of geopolitical events. We've had a lot of financial and economic events, and I think we'll start seeing the reality behind those events at least start to trickle in during Q2, and that will hopefully give us more clarity on the financial world going forward.
Can we speak a little bit on gold? Because, gold spent the last 2 years rallying as the ultimate hedge against a weaponized dollar. Has it become overowned?
Well, it's a very good point, because there was a lot of confusion in the market, particularly in March, as gold was being bought more aggressively since the beginning of the year. Gold was being bought as a protection, as a hedge to some kind of exogenous event, particularly something like what transpired in March. And what happened was the opposite of the market expectation, in that the moment Iran was being bombed, gold started selling off. And the same with silver, naturally. And the expectation didn't really work out at the time. This is actually not surprising, simply because there's the old adage of buy the rumor and sell the fact. That's one thing. The second is, from the beginning of the year into March, we saw a lot of volatility in gold and silver, and massive rallies. Gold rallied to $5,600, and silver rallied to about $120. And there was some very speculative and leveraged moves, which have since been reversed. Gold is not necessarily an inflation hedge, nor is it always a protective hedge during geopolitical events. Gold is primarily a hedge against the printing of money. Right. So the more what we refer to as fiat currencies become available, the less they are worth, and gold becomes the ultimate currency. And throughout history, it's always had that role. It continues to have that role now. It's just that probably did get a little overowned in this period, and we have to wait and see. We don't really know how much leverage there is in the system. We don't really know how much speculative capital there is in the system. We do know that central banks have been buyers of gold following the Russia-Ukraine conflict. And as long as central banks have the liquidity, that will continue to be the case. Naturally, central banks also have a balance sheet, and sometimes they have to improve their balance sheet. So we've seen a couple of central banks do some selling. Turkey and Poland were two central banks that did some selling during March, protect their currency and to fix their liquidity. That can also be a two-way street. But it is true that the recent moves in gold and silver have shown heightened volatility, and that signals some speculative positioning. So we'll have to see how that pans out going forward in the future.
As Ilias mentioned, a lot has happened in the first quarter of 2026, and that includes the Strait of Hormuz. Now, the full impact of the Strait of Hormuz closure has not yet been felt, as oil shipments that departed prior to the disruption are still in transit and continue to supply global markets. However, once these final cargoes are delivered and no new flows can pass through the strait, the true supply shock will begin to materialize. At that point, what should markets and investors look for in terms of pricing, volatility, and broader economic implications?
Well, I mean, oil is just not gasoline and diesel and jet fuel. There's so much of the global economy depends on petrochemicals, from explosives to fertilizers to manufacturing. It's an endless line of product. You know, as of last night, we have an assumed 2-week ceasefire, which would mean that the Strait of Hormuz would be opened to vessels transiting, which would, at least in the immediate, allow many nations to replenish some of their dwindling oil and energy supplies, as well as other supplies. Now, there's going to be some kind of a fallout. Even if the Straits of Hormuz remain open, there's going to be some kind of a fallout due to disrupted production, harmed wells, harmed refineries, etc. And we will not really know the effects of these until much later. It'll take months to see what the diminished supplies and diminished capabilities are and how much of an effect they have on the global markets. And it's not just the energy markets, like I mentioned, on manufacturing and production as a whole. So we have yet a lot to witness, you know, assuming that nothing new happens geopolitically, and I don't know if that's a good assumption to have at all.
And that's a wrap for today's episode of Insights Over Coffee. Thank you, Guner. Thank you, Ilias. I hope this conversation gave you a clearer perspective on how geopolitical developments are increasingly shaping market behavior, from energy and inflation to credit and safe haven assets like gold. If you enjoyed today's discussion, make sure to follow, subscribe, and share it with anyone interested in understanding the forces driving today's markets. We'll be back soon with more conversations on the strategies, dynamics, and ideas shaping the future of investing. Thanks for tuning in, and until next time.